This is Chapter 9, Video 2. Let's launch. Okay, so the learning objectives we're going to have in this slide is going to be determine the limits on deducting business expenses. And there's some statutory limits on business expense deduction that we're going to have to go over. For example, expenditures against public policy. There's no deduction for fines, bribes, lobby expenditures, or political contributions. Expenses related to tax-exempt income. There's going to be interest on loans where investment proceeds are in municipal bonds. So, for example, if I make $1 million in some investments that I make, but it's all tax exempt income. Should I be able to take a deduction against that? I mean, it's the big balance sheet. If I give you a tax exemption over here, I can't let you have a deduction over here. It kind of works out that way from a theoretical perspective. Key employee insurance premium. So if you have a key employee, and a good example of these is going to be like your CEOs or your CFOs or things of that nature, and they're worried that as they were to die in office all of a sudden, you're going to have to find somebody to take over their job, and it's going to take some time. There's going to be a monetary cost with that. So they do a life insurance policy on those individuals, and when you pay the premiums, there's no deduction. You get no deductibility on it. But the benefit, of course, is when if the person dies, and hopefully they don't, but if they do, they get the proceeds, and the proceeds are tax-exempt income. Capital expenditures, talk about that a little bit later on, and personal expenditures a little later on, and then, of course, the other two a little bit later on. Capital expenditures. So does the expenditure provide economic benefit? If it does, you must capitalize. If it fits, you must acquit, that was what they used to say in the O.J. Simpson trial. But if it fits, you must capitalize. I know, I can't get that to rhyme. But anyways, so if you got to capitalize, you got to capitalize. And there's a 12-month rule for prepaid expenses. If deductible benefit is less than 12 months and the benefits do not extend beyond the tax year, if the deducted, if it's less than 12 months or equal and the benefits do not extend beyond the year. Very good example of this would be, insurance. All right. So I've got a company, and I buy an insurance policy. It's going to last 3 years. I pay $4,000 for it. Okay. Well, actually, we'll say it goes 4 years, okay, because I want to keep the numbers even. So, in other words, when I'm going to take a look at this, it goes beyond 12 months. I'm going to capitalize that, and I'm going to write it off over those 4 years as opposed to immediate. Even though I pay the cash now, doesn't matter. I'll go ahead, and it's kind of like a prepaid if you think about it. So, it does not apply to interest expense, and that's just because of statutory requirements. 12-month example: been a cash basis taxpayer, makes the following payments at the end of the year. $10,000 for the next 10 months of utilities, $12,000 for the insurance over the next 24 months, $9,600 for the next 8 months on interest on a business loan. What amounts are deductible this year? For $10,000, you can deduct all of it because it won't go beyond 12 months. First of all, I have never seen anybody who pays utilities 12 months in advance. I guess it could happen. It depends on, maybe supermarkets and things of that nature do it if they think it works for them. But then, the benefit, ends prior to the end of next year. Ben can deduct $3,000 for insurance because the benefit exceeds 12 months. Hence, they can only deduct 6 months this year at $500 a month. And then Ben can deduct $7,200 for interest because the 12-month rule does not apply to interest, as we talked about. Business expense with personal benefits. So you can't take a deduction that are purely for personal. Mixed motive. This is a big question. So, for example, if I do business travel, I'm away from night, and it's, for some expenditures, all or nothing. So if I go away, and I say, hey, look, I'm going to go over there and I'm going to, do this whole thing. And, a very good example, my AACPA conference in Las Vegas that I want to go to. So I do that. I go there. But at the same time, I decide I'm going to take a 1-week trip. What they're going to do is they're going to say, hey, if it's business travel, they're going to say it's all or nothing. I think this is actually a change. It must be a change because I remember that we looked at this in the past and it had to be, pretty much, it was the majority for the business, but you did something for fun. Like, for example, and here's the thing, and I don't want to argue. Actually, I don't want to argue this. We're just going to pass on that. But if you want to ask me more about this, I'm happy to discuss my experiences I think there's a lot that I can share with this one because I'm not so sure I always agree with that. There's a line, and like, so for example, if I go to Las Vegas and I happen to run into my cousin at the conference, does that mean that I get to not write it off? No. Or if I have dinner with my cousin, does that mean I can't write it off? No. But if I go there and it's, obviously if I'm spending 2 months, if I'm going on a business trip and I'm there for 2 weeks and I spend 1 week at the business conference, 1 week away, does that mean I get to write off? Again, I'm not so sure, that you can do that. So otherwise deduct, the business portion. Arbitrary expense, percentage is 50%. Basis for allocation is going to sometimes be mileage or time. Again, so for example, if I'm going to take a business trip and I'm going to drive from here, say to Abilene, Texas to do business. And then after that, I'm going to drive to Lubbock, hang out with my buddy, and then I'm going to come back to Abilene and then drive back home. What portion of that's deductible? Well, it's going to be based on the mileage that I'm going to have as a result of all of that. Okay. Record keeping, document, business purpose. So record keeping, I want to talk about record keeping for 5 seconds here. Actually, a little longer than 5 seconds, but if you have a general substantiation expense, for example, I'm an accounting firm. At my accounting firm, I buy notepads. I have paper on this notepad. The IRS is not going to come to me and say, prove to me that every single piece of paper on this is going to be used for business. They're not going to. This is what's called a general substantiated expense. In other words, it has to be ordinary necessary. Notepads here in the firm, we blow through them like left, right, up, and down. This is an ordinary necessary expense. Now, if I take a piece of paper and I write it down in a message from my wife, does that mean that the whole thing's deductible? Deductibility is in question? No, that's not it. However, then you have on the flip side, specific substantiation expense. And that's going to be meals, travel, and meals, travel, and mileage. Okay. Meals, travel, and mileage. You have to have the receipt showing it. You have to have the deductibility reason that's delineated in that. And you must be able to present that at any time. And normally when you go through a business audit, if they're coming back and say they're going to question that you didn't record your income correctly, and they say that we're not going to do a correspondence audit, we're going to do an office visit. So you're going to come to my office and talk to me about your business income. And you're going to prove to me why business income was what it was. Oh, hey, by the way, while we're at it, bring me your meals, travel, and mileage. I want to see every one of them. Because they're going to ask if you have those things delineated out. And that's why if you're a controller and you don't work in public accounting, it's important for you to have those three definitely. I understand there's going to be certain times that you lose receipts. I get it. It happens. But those are the three that you don't want to lose. The travel example, he paid the following to attend a business conference in Chicago. First class airfare, hotel, meals, what amounts deductible if he spent 2 days in the business, if he spent 1 day in the meeting, and it was primarily personal. And this is where the solution is, and I'll kind of let you take a look at it. Now, that's what I'm thinking. I think for like I said, if it's primarily business, you get to deduct a good portion of it. If it's primarily personal. Now, the question of the day is, first class airfare, is that reasonable? That's a question you need to ask yourself. Is that reasonable? I'll tell you what, I am a big guy. I'm roughly about 6'4", and I weigh about 280 pounds. I'm also a disabled veteran. My back is so screwed up like you wouldn't believe, and the VA actually gives me a disability rating for it. I can't fit in the seats that they provide us in these coach seats anymore, not comfortably. And so if I'm going to fly from here, like in Washington D.C. area, to say, Charlotte, North Carolina, probably not going to be a big deal. From here to Seattle, yeah, I'm going to be in a lot of pain. So that's where an exorbitant expense for me, first class wouldn't be seen as exorbitant, because I could pull that out and say, hey, look, this is kind of what's going on. I have to have it for health reasons. And they'll usually let me get away with it. Now, if I want to just be first class from here to say China, because I'm going to go do a business trip and I don't have any of those ailments and I just want to upgrade to business class, do I have to do it? And again, it's going to come to facts and circumstances. Okay. Business interest limitation. Okay, so it doesn't apply to any taxpayer with less than 25 million, which is one reason why my firm has never dealt with this, because we don't have taxpayers that big. We really don't. So the adjustable taxable income is taxable income allocated to the business without computer without regard to the following items. Okay, so that needs to be taken into account when you're trying to calculate this. And I said 20%, I actually meant 30%. Again, it's like this big on my screen. I don't ever deal with this because most of my clients are under 26 million, so we don't have to deal with that. But this is an area that I may start getting into it, because I did pick up a couple clients next year that might be in this realm. So this is the example. So MH Incorporated reported $300,000 taxable income on $30 million of revenue, had $250,000 of interest. What's the limitation in calculating the taxable income? They deducted $340,000 of depreciation and $210,000 of business interest expense. What's the maximum BID this year? And that's how they're going to be calculating it out. And I'll let you kind of run through that. I don't want to spend precious video time going through this, step by step by step. Okay. Sale of business assets. So sale of losses on disposition of business property. Recognized losses are deductible. Losses on sales of related party are not deductible by the seller. That is actually a very important loss limitation. Casualty losses are limited to the lesser of the decline in value or basis. So what will end up happening is if you have a casualty loss. Now, we talked about this in the itemized deduction. There's a casualty loss. It's got a subject to a whole bunch of limitations. Business losses are actually not subject to as many limitations as you would imagine, because there's seen more of a, this is what I do in order to generate income. I can't complete income if I don't have the asset that's here. So there's actually going to be some stuff that goes into that. It's limited to the lesser of the decline in value. So for example, if I have, say, I pay $200,000 for something, we'll say it's a building, a land and building, and we'll say it's in the middle of nowhere, so $200,000 is reasonable. Fair market value is $400,000, 10 years later. Hurricane blows through, it wipes out the building. They say that everything in that area, because of the hurricane, dropped fair market value down to $100,000 for the land and everything. What is my deduction that I'm allowed for a casualty loss? And it's going to be based off of the, I can't take any more than the $200,000 in the basis. So there's going to be a limitation there. Okay. Basis is the amount of loss of the business asset is completely destroyed. That's kind of what it is. Okay. Okay, so accounting for taxable income. So we've learned to identify gross business income and deductible expenses. Now we need to match the income to a specific period. And that's where they're going to talk a little bit about the accounting methods where they're going to match income expenses to that specific period. So, for example, if you're a cash basis taxpayer, it's going to be when the cash is actually paid out. And when it's an accrual basis taxpayer, it's going to follow the accrual accounting, which, of course, most people in this class already know. So I'm not going to go too much into that. That's all I got to say about that. So we're going to come to the end of this video. I'm glad you guys are watching. Hang in there. We're getting to the end of class, and we're in section 3. Boy, it's an exciting time. I look forward to seeing you at the next video.